Good afternoon again, everyone. We'd like to thank you for joining us for today's webinar entitled How Healthy is Your Business? 5 KPIs Every Security Company Should Know, sponsored by Perennial Software. I'm Shannon Murphy, Vice President of Sales and Marketing, and I will help to facilitate today's webinar. First, I would like to cover just a couple housekeeping notes before we get started. Just so you know, all callers will be muted for the duration of the call. Please be sure to use your question or the chat logs to submit questions, and all questions are going to be addressed at the end of the webinar. Additionally, a recording of the webinar will be available in the resource library on esaweb.org for you to refer to after the webinar. I would now like to introduce Michael Marks with Perennial Software. Michael Marks is co-founder of Perennial. He has been in the security industry for over 30 years, starting with operating a family-owned security business for 7 years. For the past 23 years, he has been on the software side of the business with a vision to create best-in-class software for any size security company to assist companies in maximizing profits and efficiencies. Since 1996, Perennial Software has delivered on that vision through their trusted solutions, SedonaOffice and Alarm Biller. Mr. Marks has presented at PSA, ESX, ISC, Net1, SedonaOffice Users Conference, and many other industry events. So now, Michael, I will turn it over to you so you can take us through the presentation.
Thank you, Shannon. I appreciate that. Welcome, everyone, and thanks for joining our webinar today. And let's just dive right into it. Well, the first slide I had, and let me just bring this up here. The first slide I had was an introduction on myself, but I'm going to skip this because Shannon did a better job than I could ever do on that. So thank you for that, Shannon. There's the introduction in case you missed it, but I'm just going to jump right into the presentation. So today we're going to talk about the 5 KPIs every security company should know. So before we talk about that, let's just ask a real simple question. What is the KPI? For those who don't know, a KPI is a key performance indicator. Excuse me. It's a measurable value that demonstrates how effectively a company is achieving key business objectives. Now, KPIs can be both at a high level or a low level, and it really depends on what you want to look at. For security companies, a lot of the KPIs typically revolve around sales, RMR, the service department, installations, things that you're doing on a daily basis. And what's real important about KPIs, though, is that they should be used in a real-time mode. Reported on either real-time or often. And tools to report on KPIs that are very, very effective are dashboard and reporting tools. It's an excellent way to do that so the data is presented quickly, efficiently, and effectively. So tips for creating KPIs before we begin. Number 1. Make sure your KPIs that you choose align with the strategic goals and objectives of your business. There's no sense in creating a KPI that you're measuring that you're not going to be using to evaluate your business because it's not relevant to what you're doing. So as we go through the 5 KPIs today, maybe 1 or 2 of those might not be relevant for your business, or 1 or 2 others might be. Pick and choose your KPIs very carefully and make sure you use those on a daily basis or weekly basis. The KPIs you choose to measure should have data that can be easily obtained. You do not want to create KPIs where you have to go ahead and mine the data and put them together, the data that's going to take you hours and hours to do. If that's the case, you're probably not going to use these KPIs on a consistent basis. So make sure the data is readily available and easy to do. The KPI should also keep everyone on the same page and moving in the same direction. That's a key purpose of those KPIs. The data flowing into KPIs should be reliable and accurate. If you're not using good data for your KPIs, then you're going to really, it's garbage in, garbage out. Make sure the data is reliable, accurate, and you know it's correct. And does the KPI give you insight into the business that is actionable? So a KPI for the sake of a KPI that you can't take business action on is of no use to you. Make sure the KPI is relevant, so when you see something that's out of whack or not what you want it to be, you can take action to correct it, fix it, or improve upon that. And your business obviously is always growing and changing. Make sure your KPIs are doing the same. So the KPIs you have today might not be the KPIs you need tomorrow. And then one last item that's not on here that I'd like to point out is, when possible, being able to share your KPIs with other security companies who are in the same type of business as you, where you can compare your KPIs with their KPIs to see where your metrics differ, whether you're outperforming or underperforming, is essential too. So anytime you could get involved in a group or in a situation where you can collectively share, evaluate KPIs, it's a very, very beneficial thing for your business. So let's jump into it. Let's talk about the KPIs. The first KPI I want to talk about is understanding your receivables. Everyone knows in a small business, medium-sized business, even a large business, cash is king. You need money to pay your bills, to pay your employees, to keep things going in your organization. And if you don't have an understanding of your accounts receivables, you're not going to have a good understanding of your cash and your cash flow. So KPIs can be used very effectively to track your AR open receivables against your aging buckets, track your AR open receivables by type of service, and as well as tracking your AR open receivables by salespeople or any other key metrics that are important to you. So when you're looking at your receivables, you really want to look at them both, not from a micro level, obviously from a collection standpoint, but from a macro level, you need to know where your receivables should be month in and month out. Obviously, if you're heavy into recurring invoicing, the day after you do your big invoicing run, you're going to have a higher receivables. But at the end of the month or middle of the month, you should have predictable amounts of where your receivables should be at any point in time. And it's important to really understand your aging buckets. So here's a real simple KPI that almost any company should be able to do, is really looking at your total receivables by aging bucket, and then look at the percentage of the total by each bucket. Now, I put together some fictitious data here just to show you what it might look like, but you might look at the 91 to 120 day bucket here, and we could see how it spikes up. And we could see it's 9% of our total. That's telling me I have a collection issue. Why is so many receivables being pushed off well past 91 days? If almost 10% of my receivables is over 10 days past due, I have some type of issue going on, and I need to address that. And tracking this on a month-to-month basis to really see those changes, not only in the dollar values, but in the percentages, will give you a good understanding of where your agings are. Right below that, quick little graph that can be made out of that just graphically represents your aging buckets. And a lot of times, and I always like to say, the picture's worth 1,000 words. I like to see pictures. Pictures tell me something that's going on that I can just visually see, and I can really then tell me now go in and drill down into this. So that's one type of KPI, looking at your aging. Another one, for example, might be looking at your open AR by service type. So now we're drilling into those aging dollars. So we're really looking and saying, okay, of that money that's owed, how much is really from our installation department, from our service department, from our monitoring, our recurring revenue? And again, looking at that 91 to 120 days, we can see that, wow, the vast majority of that money is really coming from our service department. So that's telling me that, hey, we're doing service and not getting paid for it. Now, why is that? Is it poor service? Is it bad customers? Is it they're not happy with the results that they're getting? But there's some reason why our receivables past that time is really bumping up. And again, take action on it. Below are two different graphs that just represent that. And you notice you could really put the figures into all kinds of graphs, that represent your agings, and looking at the money that's owed to you by the aging buckets. So with each KPI, though, it's real action items. So let's talk about that. What are the action items that you need to do for your open AR? Number one, collections. You need to have a collection plan. And a collection plan is more than just saying, oh, we're going to have someone in the office call the customers when they were past due. The collection plan should be everything that you're going to do from the moment an invoice is created to how it goes out the door, how it's delivered, to how you're going to follow up on that, charges or late fees, how you're going to hit the customer with phone calls, past due notices. And you have a concentrated plan that is in production, done month in and month out to reduce those receivables. And if you do not have a collection plan, you are going to push your receivables out and out because customers will learn how far they can push you before you're going to take it. And unfortunately, people like to hold their money. They don't want to give it to you. You got to make sure that you have a plan in place to collect that money. You also need to have alternative payment options. Obviously, the two that are most prevalent are credit cards and e-checks. Most companies today that I see and that we work with take credit cards and e-checks. If you don't, really need to put that into play. It makes it much more easy and convenient for customers to pay. Yes, there might be a small fee with the credit cards, but that fee is going to be a lot less than if it's sitting on your receivables and you're aging for 30, 60, 90 days. You also need to make it easy for your customers to pay. Don't make it a burden. If the only way that they can pay is by writing and mailing in a check, it's going to be harder for you to collect all your money. Use your technicians in the field to collect money. Have an online web portal so the customers can pay. But always come up with effective, easy ways for your customers to pay. Don't let making a payment be a burdensome on your customer. It should be the easiest thing they have to do with you. Okay, hopefully that answered that. If you have any questions on that, go ahead and fill out the questions. Shannon will answer questions, as she said, throughout the presentation, as well as we'll hit some more at the end. KPI number 2, very, very important for any security company, but to identify your RMR at risk. Needless to say, RMR is one of the biggest assets and value that any security company owns. At the end of the day, most security companies are valued based upon a multiple of their recurring revenue. So it costs you a lot of money, and we're going to talk about that in a little bit, to create new recurring revenue. So once you create it, you need to do everything you can to make sure you keep that recurring revenue. And the best way to do that is to know what your recurring revenue at risk is. And being proactive about that is extremely important. It will help you lower your attrition. So what's a good way to measure your RMR at risk? It's real simple. It's looking at the RMR that's associated with that. So, your benchmark might be 60 days, it could be 90 days, it could be 120 days. You might have different benchmarks to look at it. But you're really just saying, what is the customer owe me that's over 90 days, and how much RMR is at risk of being lost? Because if the customer's not paying you, the RMR is of no value to you. Now, when you look at RMR at risk, don't look at the service income or the service aging that's open or necessarily the installation aging. Concentrate more on the recurring aging. So if a customer's paying you their monthly monitoring bill every month in and out, but they have a service dispute on one service ticket or service invoice, the RMR might not be at risk. You have just a different issue to take care of that service issue. So really concentrate when you look at your RMR, look at the RMR billings versus the RMR at risk dollars. And again, have a plan. Be proactive. Contact the customers before they're at risk. and try to eliminate that, because once they get too far behind, the chances of them making it up and going current it becomes more and more challenging, especially without either doing a write-off or doing something to mitigate that to keep that recurring revenue going. So KPI number 2, keep track of your RMR at risk. Now, KPI number 3, this is probably goes hand in hand with that RMR at risk, but it's all about your attrition and managing those attrition metrics. Now, attrition's very challenging and very difficult, but it's very well and very beneficial to make sure you're doing it. So number 1, track your attrition. And when you track your attrition, you want to track by types of changes. You want to know every reason why your recurring revenue is changing, whether it's gains, newly created, acquired, takeovers, re-signs, upgrades, or losses. Anytime recurring revenue is being decreased, whether it's being moved out of business, they sold the business, poor service, competitive rate reduction, whatever the reason is that you change recurring revenue for a customer, whether it's a new or increase or full cancellation or partial cancellation, you need to know why you did that, and that needs to be tracked. Now, on top of that, let's take a look at how we can report on that. So I'm actually using some reports that were provided to me from some of our customers. The names and some of the data has been changed, but it just gives you an idea of how they would look at their recurring and their attrition. And this first report, I know it's kind of small on the screen. There's a lot of data in here, but we're really trying to look at recurring revenue on a 12-month basis. So in this one, we're really going from January 1st all the way through the end of the year. And what we're looking at is we're looking at the beginning recurring revenue for every period. We're then looking at all the reasons why we would increase recurring revenue. Then we're looking at all the reasons why we would have cancellations. And that's going to give us kind of our, our net recurring. And then we could start looking at, things that are different additions and reductions in the normal course of doing business. And we could get down to our net recurring revenue. But the key point here is we're looking at the beginning, we're looking at the ending, and we're looking at every reason why we're changing. Now, when you pick the reasons that you're going to track, you can pick hundreds of reasons, and then you're going to have useless data. So really pick the reasons that are very specific to your business, that you can capture that data on, and that are useful for you to go back and report on. Don't overdo the recurring reasons. Pick the right ones for you. Now, what's real nice about this is if you align yourself with other companies who are doing the same, you guys could then share this data amongst yourself. And you could really take a look at where do you stand, from a competitive rate deduction, installations, what you're adding, and really be able to compare your business to another business. And this is a very, very useful tool because at the end of the day, you really want to make sure that you have your attrition under control and you're not bleeding accounts and losing value for your business. So great tool to put into place your attrition reporting. Along with that is attrition dashboards. And the reporting is a big matrix. You're looking at a lot of data, but dashboard elements will really give you snapshots of your recurring revenue at any point in time, whether you want to look at it based upon your daily, weekly, monthly, year-to-date, putting goals in mind with that so you could see how are we performing based upon our goals. So if every month you want $1,000 of recurring revenue, where do you stand on the 20th of the month? Are you on your way to your plan, or are you off your plan? So having dashboards are really nice. The other nice thing about dashboarding your KPIs and getting that data, it should be able to be delivered to you more than just going onto your computer and looking at it. You want to be able to look at it on your mobile device, have it emailed to you, bringing it up on a website, however that you need to look at it, depending on how you work. but getting that data to you in a timely, accurate manner is extremely important. And again, you could put together pretty much dashboard elements on just about anything you could think of regarding your recurring revenue. Here's another nice way to look at your recurring revenue, and this is what's called a RMR 12-month roll forward report. And this report's much simpler than that other report we were looking at that's showing us all of our cancels and ads and all that. This is just taking a look at all the recurring revenue items and looking at what is the recurring value that we had, the RMR, at the end of each month, looking at it from a 12-month roll forward. So if we run this report for this month, we go back 12 months, we could see every change, the growth of the recurring item codes. We could look at the percentage change by month as well as the percentage change by year. And it's a really amazing what the analysis will give you, because you could really then get a trend and see, you know, which services over the last 12 months have really been growing, which services have been declining. You know, where should we put in our effort into sales and marketing to continue to grow our recurring revenue? So let's talk about a few of the action items on your RMR attrition. Number one, you need to benchmark your attrition rate. Whatever that is, for example, if you say we're going to have an 8% attrition, you need to know, are you on pace? Not at the end of the year when you run one report to look at it. You need to be on top of this on a month-by-month basis. You know, maybe even more often than that. You got to report on it, you got to track it, and you have to analyze it to understand where that attrition is. A change in just 1 or 2% of your attrition over a 5-year period could be worth hundreds of thousands of dollars, if not millions of dollars, in terms of cash flow and valuation to a security company. It's probably, you know, from the big companies, there's no question they get this. They see this. For a lot of small to mid-sized companies, you know, you need to put the time and the effort into this to manage that. You need to create and look to create a customer retention plan. A customer retention plan is a little bit different than just tracking your attrition, but it's a specific plan to track, to create tasks to keep your customers and expand the services you offer them. Every customer you have is a valuable asset to you. Number one, you want to keep them. Number two, you want to figure out ways to sell them more services. You know, everyone knows, especially on the residential side of the business today, there's a lot of new players in the DIY market and the smart homes. You know, every security company is putting in smart home technologies. Do you have a plan to go to your existing customer base and actually show them what you can do for them, how you can offer a complete smart home package? Because if you're not the first one to bring that to their attention, somebody else will. And then when somebody else does, you have a chance of losing a customer. So make sure you have a customer retention plan, not only to go through the services you offer, but keeping them informed of all the other things that you do, whether it's newsletters, email campaigns, bill stuffers, whatever it might be. You know, everything that you're doing is always to make sure that you're retaining that customer. As I mentioned before, here your attrition with other security companies. You know, you're not in this alone. All the other companies that are in this industry have the same issues, problems that you do. They have the same competitive threats. Working with other companies, talking to them, is a great way to understand how you can make and lower your attrition. Shannon will be more than happy to tell you about great things that the ESA offers in terms of different events throughout the year, which are great, but it's a great way to meet other companies and to share that. And then lastly, audit your RMR on a monthly basis. If you do nothing else, do this. Auditing your RMR is no different than if you audited your accounts receivable to your general ledger, if you audited your financial statements. But you should be able to balance your RMR on a month-by-month basis. And it's a very simple calculation. Your beginning RMR at the beginning of the month, plus everything you added, minus everything you lost, should equal your ending RMR. And that's what you're going to be billing on a monthly basis from an RMR perspective. Make sure you do that. This will give you, if you do that, then you have all the other tools that you need to do all of your attrition reporting. So put that into place if you take anything out of this presentation today. Okay, KPI number 4. Know your creation multiples. Everyone knows if you're in the RMR business, it typically costs money to some extent to create new recurring revenue. So what is a creation multiple? It's basically the dollar amount it costs you to create $1 in new RMR. Now, some companies have a creation multiple that's very low, or maybe not at all. But most companies, especially if they're in the residential and trying to generate significant or high volumes of RMR, have a cost to do this. They have the marketing costs, they have the labor costs, they have the installation, they have parts, everything that goes into it. And understanding all those costs, putting that together, and then figuring out what your creation multiple is. Now, simple ways to do that is most companies, I would recommend, start off to do this at the macro level. You know, look at it from the big picture of your company. Take all of your installation revenue, less your material costs, less your labor, subcontractors, you'll get your profit and loss in doing the installation. That is kind of your direct creation multiple. Then you're going to take your sales costs. What did it cost you in terms of marketing, sales, advertising, commissions, you know, and now you're getting your creation multiple with your sales costs. And then you could start looking at your G&A expenses, depending on how you want to look at this, whether you want to take half of it or you want to take your corporate G&A expense and put that into it. And then take that, you're taking the net loss, you're dividing it by the RMR, and that's how you're getting your creation multiple. So you need to know the new RMR generated off of those sales, which goes into the previous KPI, to be able to calculate this with you. Then, once you have it at the macro level, you can start doing this at a micro level too. Sometimes that's relevant to do, especially if you're commercial and you want to get into more job costing and to understand that. But your creation multiple is going to be company performing at the level that it should to generate those new recurring revenue. So what are you taking away from this? You need to know the true cost of creating your new RMR. And it really gives you the ability to know, is it better to make or buy? Making it is what you do organically. So you are creating, you're doing your sales, you're generating it, you're determining what your creation multiple is. And if your creation multiple is 15 or 20, which is very, very good, it's a lot cheaper to do that than to go out there and buy new recurring revenue if it's going to cost you 30, 35, 40 times monthly recurring revenue to buy it. So you might as well take those same resources and assets that you're going to make the investment and use that to make more. Now, sometimes it's nice to buy because you get a big chunk, but at least you know where it is. Now, if it's costing you 50 times to make it and you could buy it for 35 times, I would stop making it and just go into the acquisition business, obviously. So knowing where those numbers are is extremely important to you. It also tells you what's your payback, what's your return on investment. You know, every security company is investing new money into creating new recurring revenue. You need to know what that return on investment is. You know, no different if you're going to play the stock market or if you're going to put your money into the bank, which you get no return on investment today, obviously. So, you know, usually, you know, for a small business, you're not going to get a better return on investment than an investment business. But we want to make sure that your creation cost is in line to get you that good return on investment. And the last thing it will tell you is what's your steady state cash flow. Steady state cash flow is really a metric that is used to let you know if you have $100,000 of recurring revenue, what is it going to cost me? And to just the first, you know, if I'm losing $5,000 of recurring revenue every year just on normal attrition, that first $5,000 that I sell just gets me back to my $100,000 of recurring revenue. and there's a cost to sell that $5,000. That cost with that $5,000 will tell me what my steady state, the cost of being steady state, keeping that $100,000. Anything I sell above that replacement value, that's my gain. So when you're looking at that, then to get that gain, obviously you want to know what those dollars cost you as well. If you have any questions on steady state cash flow, it's probably something that we could talk offline about. It could become more of a complicated subject, but it's a very, very useful KPI and reporting tool to know. And as you move up the financing ladder to working with bigger and banks and want more money, this is something that all the banks want to know about is, what is that steady state cash flow? Because for them, that just tells them what does it cost you just to stay even in terms of your recurring revenue. Then let's move on to the last one, KPI number 5. This is a little bit different. This is something we do within our business, and this is something I work with a lot of companies on, and it's a very, very important metric to know. I have never seen a security company. I've seen all kinds of statistics on attrition rate, steady state cash flow, all kinds of metrics. But a metric to know, what is your revenue per employee? And I haven't seen this as much shared within security companies, and it's a good thing to look at. So it's a key metric to understand how your business is performing. And when you look at this, you need to set a goal for the profitability of your company as a percentage of your gross sales. Then what you do is you set an allocation of your expenses. And really, when you look at your expenses, you really break them down into 2 categories, employees and operations, everything else. So you have your employees is the salaries that in the compensation you're paying your employees. Operations covers this is buying materials, rent, utilities, employee benefits, everything else falls into that. And then really simple, think of it from this point of view. You can put into a plan for budgeting creation. So I'm going to give you a real quick scenario. This is a do, and then to measure on a month-by-month basis. So in this example, I'm using what I call a 40-40-20 example. And what that says is, in this example, we want 40% of our expenses to be for the employee's pay. 40% is for our operations. 20% is our profit. So we want to profit 20% for every dollar we bring in. So if we look at it from the top, in this example, we're going to do from a company annual revenue $1 million. So if I have 8 employees, my average revenue per employee is $125,000. Now, let's take a look at the allocation underneath it. There's our 8 employees we have listed, and there's their annual salary. And that's just their gross salary. Does not include expenses. It doesn't include benefits, taxes, or anything. That's all going to be picked up in that other 40%. Now, granted, this is just a scenario that I put together for this. Your numbers and your percentages might change. There's no set rule on what it should be, but it gives you an ability and a tool to look at that. So if I know that 40% of the revenue of the salary, I can do a revenue allocation per employee. And that really becomes just a formula. It's 40% of what the revenue should be, or in this case, 2.5 times the annual salary. Looking at there, we could see the revenue per employee. And this is a way that we say for each employee, this is a revenue allocation. So if they turned around and we paid this person $25,000, and if they really did a revenue allocation of $62,000, we should make $12,500 based upon that. Now, in this example, you could see we're skewed because I have $460,000 of annual salary, at 40% on $1 million, it should be 400,000. So according to what we put together, either I change my numbers, or I need to bring my sales up, or I need to bring my salaries down. You could see also is based upon this, and if I only do $1 million, I'm not going to get my my 20% on that type of sale. I'm going to actually go and be, maybe if I'm lucky, 10%. So it's a way to look at your business from a different set of view. And you're looking at it from the employee level and understanding that revenue per employee, and then understanding the mix of how you're going to allocate that. It's a tough exercise to do, but it's amazing when you put this together and you lay this out, and then you report on this on a month-by-month basis. You might see that you need to tweak some things, but you're going to get a great snapshot and analyzation of your business like you never did before. If you do this, I'd like to know not only what your goal is for your profit, but what your revenue allocation and how you look at that from doing that. And again, that could change based upon the security company you are. You know, if you're heavier into large-scale commercial installations with really large material costs, you know, those operation costs are going to be higher than if you're more into the residential side of the business. So it's not one simple way to say that this is the same formula for every company. So takes away for this, number one, it's a great tool to use for budgeting. It helps determine if all the employees are pulling their weight. It's amazing when you look at this and you say, hey, I got to take that revenue, the total gross revenue of the company, and I have to spread it out amongst every employee. Because every employee, whether they just sit there and answer the phones and they're administrative, to whether they're in sales or installations, they're driving revenue into the business, and revenue has to support them. So you have to put that revenue allocation into them. You know, some people do more, some people do less, but then you look at it and say, am I overcompensating? Am I undercompensating for someone? And again, as I said before, it's a different way to look at the business. And it's a very unique way to look at it too. But the trick to do this is to determine your allocation, what your employee percentage is, what your operating costs are, and what your profits are. So it's another nice way to handle that. So with that said, I want to thank you for attending today. I hope you got something out of this. If you walk away with one good KPI that you could put into your business, I'm sure it will be a benefit for you. Shannon, I'll turn it over to you now, and if there's any questions, I'll be more than happy to answer those.
Perfect. Thank you so much, Michael. I think this is really helpful information and lots of good tips in there. We do have a few questions, so if you guys are thinking of any that you would also like to ask, please make sure that you enter them into the question log or the chat log that's on your GoToWebinar control panel. So, Michael, one of the questions that we have, somebody is asking if there'll be an electronic copy of the presentation. I can even answer that one if you'd like. There will be a recording of this webinar that will actually be available in the esaweb.org resource library. If you have any trouble getting to it, just you can email me after the webinar. You will get a follow-up email, and I can certainly send you a direct link as well. But Michael, I do have another question here. Someone is asking, do you have any examples that you can provide on cost-effective ways to communicate with your customers in order to preserve RMR?
Absolutely. That's a great question. So think of all the ways that you're already touching a customer and how you could piggyback along with that to give them additional information. So the first thing is most companies send an invoice at some point. So every time you're sending an invoice to the customer, think about adding some other means to touch base with them. Well, a bill stuffer. So just adding one piece of paper into that invoice is a great way to do that. And then obviously another very cost-effective way to do that is email. Email, very cheap, very inexpensive, and for existing customer bases, you should get a pretty high response. Now, one effective way to communicate with your customers via email is to do surveys and to find out how you're performing. And today, what we're seeing used more than ever before is what's called the Net Promoter Score. So if you're familiar with a Net Promoter Score, it's really a real simple concept. It's asking the customer one simple question when you're done doing either service or installation or working with them. And that question is this: on a scale of 1 to 10, how likely are you to refer us to somebody else? And if you find that a customer is giving you 9s and 10s, you know you're doing good service. If you're getting anything but 9s and 10s, you need to pick up the phone and call the customer and ask one simple question: why? And what could we have done to make it better for you? Because you need to make sure that you are giving the best service and your customers are willing to refer. A good campaign on a Net Promoter Score, you should be able to get back 30 to 40% response. And that's a great sampling and will really let you know how you're doing with your customers. So those are just a couple ways, Shannon, to reach out and touch customers.
Okay, awesome. I have some more questions coming in. So this was early on that he entered this, so I'm not sure exactly what he was referencing, but he was asking if one of the report formats was inside Alarm Biller. So Michael, maybe you could just mention, which of the report functionality is kind of available potentially, and that might answer the question.
Okay, yeah, so a lot of the reports that I showed and a lot of the ability to get this data obviously is available within our products, both within SedonaOffice and Alarm Biller. And what I would suggest is, instead of going through that on this call, please feel free to either give me a call. My phone number is on the board right now, or drop me an email, or just go to our website, perennialsoftware.com, and just send us an email, and we'll be more than happy to discuss any specific reports or ways to capture and create these the data that we talked about today.
Okay, perfect. And here's another question for you, Michael. How do you allocate profits comparing a salesperson to a clerical employee?
Yeah, that's a great question, because it's hard to do. A salesperson could be responsible for bringing in $1 million in business, or 500,000. A clerical person doesn't bring in a dime sometimes, But when you do that formula that I talked about before, and you lay out every employee and what the gross pay is, you use the same formula to do the revenue allocation for them. Because at the end of the day, you're distributing it equally amongst the business. And it's more subjective, and they're absolutely right. It's not, you can't just say that salesperson, well, they should be more valuable. Well, they're going to probably make a lot more money too than that administrative person's going to make. But by doing it in this fashion, it gives you a uniform look to say, this is what every employee's revenue allocation is. And sometimes you're tweaking it and you're playing with the numbers to make them work out. And then you'll see, hey, someone's either overpaid or underpaid in terms of how you're doing that. But again, if anybody would want to go through that exercise, I would be more than happy to set up a time and kind of show them and spend a few minutes with them and do that, and how we do that internally, and how I do it with our business to look at how the allocations work.
Okay, perfect. And I have some more for you here. Somebody is mentioning the 40-40-20 is great. Do you have any documentation on how to share this with employees to get them on board, or maybe how other alarm companies use this to get their employees to buy in?
Well, I'll be honest with you, I haven't seen this being used by too many alarm companies. We use it here internally from a high-end management point of view. So, I'm not saying that you can't use it and share it with your employees, but it's more for us on how we budget and create our annual budget. And we look at it from the, we're very labor-intensive in our business, and I'm sure a lot of security companies are also. So I can't answer that specifically, but all I could say is, I think there's no rules in terms of how you use this and how you present it to your employees, or if you just use it at a management level. So I don't know what else to say about that then.
Okay. And this is actually going back to the previous question, more about allocating profits across different functions. Someone is asking, distributed evenly or prorated by their salary?
Well, the formula is actually distributed evenly on the same basis. So if you do that 40-40-20, you're doing that for every employee. So, if an employee $10,000, you're doing an allocation based upon that. If they make $50,000, so if they make $50,000, they're going to be responsible for more of the revenue. But the idea is you use that same formula throughout the whole organization. Because otherwise, what you're going to be doing is you're going to be justifying what somebody who is more, like we've talked about before, because they're in sales, well, they bring in a lot of revenue, and someone who's not, they don't bring in one. Under this formula, everybody is allocated to that same revenue that's coming in, because at the end of the day, you have a big bucket of revenue. That's all the money you're going to do in the year. And you're sharing that equally for every dollar of payroll expense you have, okay? So even though someone doesn't bring in revenue, it's still, you need that revenue to not only pay them, but to pay the operating expenses that is associated with them. So this isn't the budget that your traditional budget where you're looking at, your cost of goods sold and your other expenses. What you then do is you take this analysis and you plug in your regular budget and you make sure they're aligned. Because at the end of the day, you want to drive a certain percentage of profits to the business for the revenue that you're bringing in. Now, there are some security companies that their profit wants to be zero at the end of the year because their only goal at the end of the year is to generate more recurring revenue. And that's fine if that's what your business goals are. So it's just a different way to look at it, and it's a really useful tool once you get the concepts and the understanding down of that.
Perfect. Michael, I think that is all of the questions so far. I wasn't sure if there was anything else that you wanted to add before we kind of wrap it up.
I just want to say thank you, Shannon, for putting this together today, and thank you, everyone, for showing up and listening. And again, if you have any other further questions, please feel free to reach out to me, and would love to talk to you. And if I don't hear from you, have a great Labor Day weekend.
Fantastic. So thank you, Michael, and obviously to Perennial for sponsoring this webinar today. And thank you all for joining. Hopefully you found the information very useful. I certainly did. And I would like to remind everybody that there will be a recording. We were getting several of those questions throughout the question log there. The recording will be accessible on esaweb.org in our resource library. And Michael had also mentioned earlier in the call that benchmarking against other folks in the industry is a really good practice, and you can certainly do that at a lot of our events. So Michael, thank you for mentioning that. We do have our Rising Leaders Forum coming up in Washington in October, and then our Leadership Summit is also a really great place to do some of those things, and that will be in Tampa in February. So if there's anything that we can help you with there, please don't hesitate to ask. So again, thanks everybody for your participation. We appreciate your time, and hope that you have a fantastic rest of the day. Thanks, everyone.
Thank you. Bye-bye.